Yes, please.
Good evening, everyone. I am Priyanshu Sharma, and I welcome you all to the third day of Finance Lecture Series 2020, organized by I Am Koi Code. Thank you all for your enthusiastic response on day 1 and day 2 of this lecture series. Today, we are honored to have with us Mr. Ashishkumar Chauhan, MD and CEO of Bombay Stock Exchange, which is Asia's oldest exchange with more than 5,000 listed companies. Today's session would be moderated by Professor Sony Thomas, faculty in Finance and Accounting area. I extend my warm welcome to both. Now I request Professor Sony Thomas to take the session forward. Over to you, sir.
Thank you, Priyanshu. Hello and welcome everyone to the third day of Finance Lecture Series organized by IMP. We have a significant number of students interested in finance who want to make a career in finance. This year, we have also started a PGP program in finance. We are conducting this lecture series so that students will get exposed to various domains in finance and also the latest trends. As you know, stock exchanges are an integral part of financial system in any major economy. They provide liquidity, price discovery, and avenues for risk management to various participants in the industry. BSE and NSE are the prominent stock exchanges in India. We have a very special guest as speaker for today, Sri Ashishkumar Chauhan, MD and CEO of BSE. He is instrumental in various landmark innovations in the Indian financial markets. I'll be erring on my part if I don't mention some of those for the benefit of the audience. He is credited for reviving BSE, including making it the fastest exchange in the world with less than 6 microseconds response time. Introduction of mobile trading, state-of-the-art online real-time surveillance system. He also completed successful IPO of BSE in January 2017. In October 2018, BSE became the India's first universal stock exchange and currently offer all asset classes including equity, mutual funds, currency and commodity in its portfolio. He started his career in IDBI, held top positions at NSE and Reliance Group before joining BSE as Deputy CEO in 2009. He was part of initial team to set up and operate NSE. He was also instrumental in creating NSE 50, the largest traded index derivatives in India, for which he is known as the father of derivatives market in India. He also served as the CEO of Mumbai Indians IPL team. He holds a BTech in mechanical engineering from IIT Bombay and MBA from IIM Calcutta. Without much ado, I invite Sri Ashishkumar Chauhan to deliver the talk on evolution of Indian exchanges and its future. Over to you.
Thank you, sir. Yeah, thank you, sir. Good evening. It's a pleasure and honor to be talking to you today. So how much time do we have?
We have around 30 minutes for the talk, followed by the Q&A. You can take 35 minutes also, 35 to 40 minutes also. That's fine. It's up to you.
Okay. Sure. So we'll go on till 7 and then we can do the Q&A, right?
Sure.
Okay. So basically, I think there are 33 participants currently, right? So, and all of you are interested in finance. So I'll take up finance as basically many facets. And many times we ask ourselves, what is finance? Everyone will give different answer. It is like 5 blind men describing elephant. Everyone has a different idea of what is finance, and all of them are correct and all of them are wrong. So effectively, when I studied finance like all of you at IIM, and despite that, we had very vague idea of what is finance, what does it do, why is it required. None of us taught that, nobody talked about it, no book actually bothered to give finance as a concept. They would give you books on portfolio management, on derivatives, on banking, on project finance. But what is finance? Is something to do with money finance? Or is something more than money is finance? And what do we do with that? Those are the concepts I thought I will also share with you. It has a huge implication on how the markets work. And markets are of various types, of course. So I will touch upon that also. But basically, finance is a very interesting concept. Okay, it has something to do with money, of course. But it is like blood in a human body. On its own, blood has no relevance, right? If you take out blood and put it in a plastic bag, you can see it's a red liquid. It doesn't do anything. It can do nothing. It's a dead thing, right? So finance does not exist on its own. It exists in a context of a society, right? So that is the first part of it. Many times in most countries, most people's mind, finance exists for itself. And that is what most bankers think, that the world exists to give them bonus. It doesn't, right? Similarly, world does not exist because finance has to exist. Finance exists because the world has to exist, right? So that is broadly the situation. But what blood does in body is that it takes nutrients, it takes oxygen from where it is available in the body to all the cells in the body which require the energy, nutrients, oxygen, and takes out the bad part and sends it to where it is sort of to be flushed out, right? So similarly, finance also takes the money from where it is available to where it is required for short term, long term. The nutrients are the long term, right? The oxygen is for the short term, and so on and so forth. So that is what you need to keep in mind, that finance is basically a parasitic activity. In fact, in one of my award ceremony, which was given in Kuala Lumpur for the Asian Banker Award, Mahathir Mohamad, who got sacked recently, he was the person who was giving awards, and he said that what did finance do in last 50 years? And that is actually a question which many people ask every day, that what does finance do for the society? And in fact, many people believe that finance doesn't do much. In fact, it takes away much more than what it gives to the society. So you need to keep it in mind that there is a reputation issue, especially in last 50, 20 years, and after the global financial crisis, that most people think that people who work in finance are basically not doing great work for the society. We all have the onus on us to improve that. But having said that, the finance is an important subject. Without that, societies cannot function well. And that's why any type of financial system would be better than not having them, right? So if the choice is between having blood and not having blood, then clearly having blood is the only choice. But having healthy blood versus not having healthy blood is the difference you need to worry about. And there are two legs to any large financial system, any country. One is what I call the intermediation system or the banking system, where you pay the money to the bank as a deposit, and then banks on lends to somebody, and at a higher rate or lower rate, whatever. But the bank is taking money from you as a principal. If the counterparty fails, you don't have to worry because bank will make it good. That is a theory. In practice, banks also go bust, especially rest of the world, not in India. In India, we have created an illusion in last 50 years after the nationalization of banks, that banks don't fail. It is not true. Banks do fail, but we pretend that they don't fail. And somehow RBI, government put together, ensure that the banks, the larger ones, at least do not fail. Recently, of course, you might have seen some cooperative bank in Bombay failing. But other than that, you don't see, because as a society, we want to create an illusion that banks don't fail. And that creates what I call moral hazard. People put in money in banks, even for 1% higher interest, 2% for higher interest, assuming that banks will never fail. So that 2% is free, right? So actually they are putting in a more riskier bank, but they don't care because government is going to expect it to come and put in money. That's what happened to the depositors of the bank which failed in Bombay, right? Recently. But the other bank which failed and government came in and put in money, like Yes Bank, right? Government ensured and RBI and put together, they created a rescue package and stuff like that. Why I'm telling you this is, it's an illusion which our society over last 50, 60 years have created. That doesn't mean that illusion is reality. And it has real moral hazard, because people put in money blindly, because buyers don't have to beware. They don't have to worry about who they are giving money to. Bad bank or good bank. But that is one leg of our society, in economy. The other leg is the markets, the stock markets or the capital markets. Why they are called capital markets is because they are for long term. But then there are short term markets also, like overnight repo and stuff like that. So those are the markets part of it. This is the intermediation is the bank. The disintermediation is what we call the markets, where when you put in money in an equity share of a company, you put in money directly into the company. At least you become the owner of the company directly. The money may not go directly because it may go to the previous owner if you are doing it through the secondary market. If you do it through primary market, there is a chance that it may still not go to the company because the original shareholders are selling. It's called offer for sale. And if the company is really collecting money, that's called IPO. But you become the real owner of the company. And if company does well, its profits increase, then your share of that profit, which is what is represented by shares, will actually increase. And that's why the price of that company shares might increase, because people think that company is going to increase the share profit. And that's how they try to sort of extrapolate, make the net present value of those cash flows in future into now and try to do that. That's the theory. And that's why the disintermediation is where if you buy a debenture, you are dealing with the company directly. If you buy shares, you're going to deal with the company directly after you have those instruments in your account. Till the time you will be dealing with brokers. Brokers who are specializing in making those transactions for you, getting your money, giving it to the other guy, and then getting those debentures or your equity shares in your account called depository. So those are basically the brokers are the people who specialize in that kind of job. In a way, the markets for money, which is short term, is called money market. Anything else is called capital market, whether it is for few months to several years, and some of them are perpetual, that is for eternity, provided that entity exists for eternity and everyone else exists for eternity. Sometimes that entity itself goes down, and there were war bonds between the American sort of revolutionaries and the Britishers, and some of them expired worthless because the entities themselves stopped being there, right? And so, but there are perpetual bonds, and there are 10-year bonds, 30-year bonds, 50-year bonds. Of course, equity is also perpetual till the time company dies. So it's called going concern in accounts. That company is going to exist forever unless proved otherwise, right? And so I'm using a lot of language which you might not be used to if you are in the first year. If you're in second year, probably you might have come across this sort of wordings which I use. But you don't have to worry. I try to use minimum jargon to the extent possible. So don't worry too much. And then the capital markets, where does the word come from, right? All of you are past cat. You are what I call among the cream of India. So you would know the capital word comes from concept of capita. Capita means the head, right? You have heard of per capita income. You have heard of capital punishment. Both of them have the same sort of concept behind. That is, capital punishment is you cut the head. That's why it's capital punishment. And per capita is you have the per person or per head income, right? And so on and so forth. So you have heard of GDP per capita and all those things. That's how it works. So why capita or capital came to be known as wealth in the olden times? If you had more heads with you, more sons, more daughters, more slaves, more goats, more bullocks, more cows, then you were richer compared to other people who had to work hard to get their living. Whereas you could basically have milk from goats or cows. You could also kill them to eat and stuff like that. So that's how basically those people with a lot of capita, a lot of heads under them were richer people. And that's how anything which produces something else, because cows produce themselves, right? Newer cows, chickens produce newer chickens, unless of course there is a pandemic. But generally that's how this is considered. The slaves produce new slaves and stuff like that, right? So that's how the capital and the markets where you sell or buy things which produce something else in the long run is the market for capital. Or that's how this business of capital markets, and markets are places where you decide to trade and you end up trading basically, right? Of anything. You can have vegetable markets, you can have markets for fridge, you can have markets for entertainment like movies, and you can have markets for long-term assets, which is capital markets. Why capital markets are different from other markets is because in other markets, you buy a fridge and you start using it, right? You're not going to give it back after 5 years or 2 years, or the buyer doesn't expect money back after a few days at least. Nowadays, Amazon will give you ability to return, but that's not the same concept. While in capital markets, you give your hard-earned money to somebody, but you also expect it to come back by way of profits in case you bought shares, or by way of interest in case you bought debentures and other things, right? And so, in a way, the markets for capital is very different from the markets for vegetables, where you buy vegetables, you give money, you're out. You buy a fridge, you're out, right? You pay the money or EMIs and stuff like that. And so those are basically markets for goods and services. This is market for capital, where the money has to come back, the interest has to come back, and sometimes they may not come back, but the rules of the game are known to people, that if you're investing in stocks, the company share prices may go down or go up. And so you are expecting that, but you are not expecting that the money which is taken from you is being used by the company or company's management for some other reason, right? And that's where basically the government comes into play, or the regulators like BSE or SEBI, which is a higher level regulator, come into play to create frameworks to ensure that everyone is aware of the expectations from each other. Everyone gets the information they require to make those decisions and continue to make those decisions. And so there are regulators like SEBI. In America, it's called SEC, which was, I think, set up post 1930s after the Great Depression. And then in India, it was set up in 1989, but it got powers in 1994. And so it's of recent vintage. But effectively, the regulators define how the regulations are going to happen. Before the SEBI came in, Ministry of Finance used to run the regulations for that. And there were many interesting things those days. Later on, when SEBI came, it changed many of that, but many of them still remain. And the basic framework, a company, also you need to be aware that companies are legal fictions, Companies don't exist like we do. We are physical people. We can be touched, felt. Cats, dogs, all of us have physical existence. Companies don't. Companies come into existence because the law says that these are the companies, but they have all the other rights of entering into contracts, of having legal rights, and so on and so forth. So we have created as a society a legal fiction, which is called itself a company. And there are methods by how you can set it up, you can run, and then of course, if the company makes profits, then it is shared amongst its shareholders. And if the company makes losses, then company shareholders' value or wealth goes down by so much. So that's broadly the concept. And so companies are regulated by an act in India called Companies Act 2013. Earlier, there was a Companies Act 1956. Before that, there was the Companies Act 1850, and so on and so forth. So the newest Companies Act is basically an outcome of older Companies Act plus experiences people had over so many years to basically ensure that people do misuse their authorities and things like that. But that is not the topic of understanding today. So BSE was set up in 1875. That was the first exchange to be set up in India. But before that, in 1820s, 1830s, Calcutta used to be the capital of British India, you might be aware. Only in 1911, Delhi became the capital. Till that time, Calcutta used to be ruling sort of a place for entire India, which was being ruled by Britishers. Of course, there were many princelings and they used to rule a little bit, but effectively, Calcutta is where all this new finance started evolving. 1820s, 1830s, there were banks which were set up by Britishers or foreigners like Dutch and all those guys. And those were taking people's money. They were using that for trading in opium and other things with China, which Britishers used to do and stuff like that. But their bonds were traded in Calcutta in 1820s, 30s. Similarly, in western part of India, Bombay was the British place. And that's where all these things started. And there were merchants which would trade cotton, they would trade spices, they would trade anything, and they will also trade into these bonds. And that's how the trading of bonds started in banks and things like that. And slowly, they realized that 1850s Companies Act came. 1857, we had the first revolt or the first fight for independence happened. But same time, the first railway was set up from Bombay to Thane in 1853. And similarly, the Companies Act also was sort of created and passed in British Parliament, which made it applicable here also. And that's where the companies started coming up. And the initial companies were basically into shipping, make ships, repairing ships, and in textiles and other things. And there, sort of people who promoted them, they started collecting money from other people whom they knew, they didn't know, and their shares started trading under a banyan tree. If you have visited Bombay, or if you have not visited Bombay, when you come to BSE, near BSE, there is a place called Horniman Circle. And there, under a banyan tree, this activities started along with trading in cotton and all. There are photographs of those times. And first, they will trade in those stocks using shaking of hands. So you want to trade with me, you catch me, and both of us shake our hands and then put a handkerchief on top of that. And then you negotiate with the movement of fingers, and nobody else knows what trading we are entered into. And so that was completely non-transparent. Today also, if you go to Myanmar, which is Burma, on the Indian side, jade, jade is a stone, very important stone, very costly stone. Their traders do it this way, shaking, the handshake and the handkerchief framework. But later on, more stocks started coming up and they started putting on blackboards. And then even larger number of stocks came, and then they started putting it on shouting basis and writing each other's names and things like that. But they were all getting together near that banyan tree in open, and they used to make a lot of noise. So the other merchants will call up the police and tell them to throw these guys out, and police will go after them, and they will go and stand in a corner around 200 meters from Horniman Circle. And that street started being called Dalal Street. In 1875, these people got together and set up their own association of persons, which is like a cooperative, and with 1 rupee as a membership fee. And they were all similar caste, largely Gujarati Banias and Marwadi Banias, and some Parsis, some Muslims who later on migrated to Karachi and set up Karachi Stock Exchange post-independence. So these guys started having, they became rich enough, they started having their own building in a place called Dalal Street. And so that's where currently BSE building is, where the current BSE building is slightly sort of newer variety, but it's the same place as the original building stood, but now it's multi-storied and stuff like that. And there was a big floor those days where people will go trade with each other, write down their names and how much they've sold or bought at what price in their small little booklet. The other guy will do it themselves, and then at the end of the day, both of them will send each other the trade sheets, and that's how this is to happen. And then it lasted till, of course, then independence of India came in between. Some of these brokers also participated in the freedom movement. They were disciples of Gandhiji, many of them. In fact, Baba Sahib Ambedkar, after he came back from London, he was working as a consultant to BSE brokers, giving them papers on how the economy will work, because he was a great economist also. In fact, he also wrote a paper which finally was accepted by British government, and RBI was set up through that paper. But some connect to freedom movement also BSE has in that context. And then India got independence, then this Companies Act got changed in 1956. Not much, but the new parliament had to adapt it. That's what they did. And then till 1991, it used to happen on floor. People will, and if you even now, if you come to BSE building and go to the floor, Then each pillar of the floor, which is called International Convention Hall now, but it's a floor, trading floor, and each pillar has an alphabet like A, B, C, D, and so all the trades would happen in the company starting with A in that pillar and B starting then that B pillar and stuff like that, right? So that's how this used to happen. In 1991, India had a serious balance of payment crisis, and so India started liberalizing. Before that, we were a kind of we were pretending to be a socialist country, which still we do. Our constitution still says we are the Socialist Republic of India. There was no socialism then. There is no socialism now, right? But we like to do everything half-hearted. We did completely bogus socialism those days, and we are doing even worse now. But that is besides the point. In 91, before 91, we were very inward-looking country. We didn't want to trade with the rest of the world. But 91, we had no choice. We started trading with the rest of the world, and policy started liberalizing, as they call it. License Raj got removed. Many of the licenses which were required were not there, and then the market stock exchange index started going up. Sensex started going up, and the government thought it's going up because of the great work they are doing. But actually, there was a broker called Harshad Mehta who was taking money from banks in a nefarious way and putting into stocks. So prices of stocks were increasing. And then that scandal came out. It's known as Harshad Mehta scandal. And then government realized that if they have to move from a banking dominated economy to a kind of a balanced market versus banking kind of economy, they need to have modern exchange. And that's how they set up a new exchange called NSE. And they told IDBI to set up, but finally it was set up as a completely automated exchange with screen-based trading. It was the first time literally in any large country in the world, screen was being used to match the trade, not only display the rates, but and then later on call, but actually trade. So US, Europe, Japan, all of them became automated after India raid. NSE started their debt market around early 94, May, June. Equities, they started around November 394. And the BSE became automated around June 95. So within quick succession, both of them became automated. So we had a screen-based trading, but all our clearing settlement, that is the post-trade work, was still on physical papers. And physical papers had a lot of problems because people used to print fake certificates and all. And so we had to work on that. Government of India passed a new Depositories Act. And that's how a new depository came into existence called NSDL. Later on, another depository came called CDSL, which has become now much bigger than NSDL also in terms of the number of transactions. But effectively, the depositories solved the problem of the bad deliveries, which used to happen in Indian stock markets. Then in between, we also created a trade guarantee framework, settlement guarantee framework. Before that, there was no settlement guarantee. So each time you traded, you thought you've agreed to trade on agreed to exchange on a particular rate. After 15, 20 days, the person may not be actually, that entity may collapse and they may not be able to fulfill the obligations on your side. And that's where basically the settlement guarantee framework was evolved. Clearing corporations were set up. So you had three pillars of stock markets, which is exchange, clearing corporations for guaranteeing settlements and doing clearing settlement, and then the depositories and banks, one for the stocks, other for the money. And so all of them are completely automated in India. We are literally, BSE is the fastest exchange in the world with 6 microseconds response time. So anytime you want to trade, you get a response time of almost 200,000th of a second. And you might think, what is the need for such a fast response? Because humans can't even trade more than, see more than 22 frames in a second. Why you are trying to do it 200,000th of a second is because nowadays computers place most of the orders. They're called HFT, high frequency trading or algorithm trading. And they put in a lot of, they are able to recognize even billionth of a second, not a millionth of a second. And so there are people who specialize in that. There are people who specialize in making algorithms to read up all the news and then place orders. There is no human involvement after they made the algorithm. Artificial intelligence, big data, All sorts of things are used to, of course, people use astrology also. And so there is a variety of framework, technical analysis, fundamental, all sorts of things people do. You can see them on TV, but effectively, it's not easy to predict movements of markets. There are literally billions of parameters, and all of them, how they play with each other, nobody knows. And that's what allows the markets to become more interesting. But in 2000, we started derivatives in equities. Around 2003 or 2002, we started commodities derivatives on automated exchanges. Before that, India had commodities derivatives, but on single commodity on a physical floor. And those were like small, tiny exchanges, like 2-3 people, employees, like exchanges. But the newer exchanges were automated, the larger ones, and some of them still survived. And then 2007-8, we started with the currencies derivatives and interest rate derivatives on Indian markets. And later on, we started mutual fund distributions and stuff like that. Now IPOs, everything is pretty much automated. India is the lowest cost, fastest response time having automated stock market system in the world. And that's what it continues to aspire to be, the world leader in terms of automation and all the functions that are automated. But still, there are many other things which we could have discussed. I have just given you in 30 minutes the perspective on how India's journey on stock markets have happened, what is the meaning of finance, how the capital markets are important, how they differ from other markets, and so on and so forth. But broadly, that's what I thought I will cover in 30 minutes. Thank you.
So thank you, sir. That was a very interesting talk. I particularly like the talk for three reasons. So one is the simplicity in which finance is explained. Second one is talking finance without any numbers. So normally when you say about finance talk, right, people expect numbers. So you explained most of the elements of finance without any numbers. And the third thing is that you linked it with history. So if you ask me, what is one of the subjects which is least taught in finance in B school is the finance history. So you link the various financial aspects with the historical aspects. So if I just summarize the talk, basically we started with what is finance and analogy to blood. So that was very interesting. And various players in the financial markets, intermediaries, banks, money markets, capital markets, regulators. Linking it with the history, that was the most interesting part. Basically the history of finance trading in India, history of BSE. And finally, you concluded it with the current trends. And the most important thing personally for me, and I'm sure same is the case with the audience also. So one question which we should always ask, what is the relevance for the society? So that is a key takeaway from the talk. So whatever we are doing in finance, we should always ask this question, what is the relevance to the society? With that, we'll come to the question answer session. So I'll take the privilege of asking the first question myself. My question is regarding private equity versus public equity. So if you look at the US, number of companies taking public capital reduced significantly, and number of companies taking private capital increased significantly. And if you look at the Indian context also, we can see the same type of situation recently. Some companies which are having high growth and which are having high impact, they choose to remain in the private market for a long time. So they are not in a hurry to make the IPO market. So I would just like to get your thoughts on this. What exactly is the reason for this, especially in the new age companies? Is it due to regulation or some cost benefit analysis this company is doing? I would like to get your thoughts on this.
It's a very interesting question. Basically, it's a very complex situation. All sorts of parameters have brought us to where we are. Some of them basically relate to the excessive regulations that have come into the public markets. Because in earlier times, it was a laissez-faire market. The companies used to take money, and many of them did not give any information, and they collapsed without a trace, or they went away without a trace. They are known as vanishing companies in India. And so the public started putting a lot of pressure on governments and regulators, saying, why you are allowing such activities to happen? People are putting their hard-earned money, and you need to put rules in the game, the rules of the game into process. And anyone doing such activities, you need to take them to task and do things with them. And so make examples out of them. So that is where the regulations requiring initial information called prospectus came in, which is basically about disclosures. That you have to disclose everything about your business, about your plans, about your directors, about your customers, everything. Even what school they studied in, vis-a-vis what court cases are there against them, and things like that. So it was like a lot of information people have to give. Many people don't want to give those information on variety of accounts. So that is one part. The second part is because the regulations evolved much in a different direction. They had to also create regulations for being able to continually list. One is you come in to collect the money is one part. But after collecting the money also, many companies were not giving information in quarterly basis or annual basis. When I joined stock markets in 91, 92, it was very rare that a company will give you annual reports every year for 5 years continuously. They would extend their account year by 6 more months, 3 more months, and they will do all sorts of juggleries there. And slowly the regulations tightened. So the onus on the managers of the companies became much more, and they became personally liable. Even the directors have now become criminally liable and things like that after the New Companies Act. So more and more regulations happened. Similarly, that has happened in US, Europe, and so on and so forth. So that is one part. Second part is also more interesting, that the new age businesses ended up giving huge returns if they succeeded. Whereas the old age businesses were very linear. You have to put in so much money and you will get so much money. Like you have to put in plant, machinery, this, that. Everything was reasonably calculable. So they were linear payoffs. You put in X, you will get probably 3X in 10 years and things like that, right? So barring, minus cost and other things. And that's how that linearity was there. People would calculate. And people who wanted 3X in 10 years or 3X in 20 years would put in money in those kind of companies. Those were what I call easier days, simpler days. Companies would last longer and things like that. But over last 30 years or 40 years, new age companies came which were nobodies. And when they grew up to become massive. One of the earlier example was HP or IBM, which were basically run-of-the-mill companies, and they became massive. Then later on, Microsoft came, then Apple came, and then went down also. But many such companies came up later on, which were basically high-tech companies or new age companies. And they ended up giving you non-linear returns. You put in, say, 1 million and you might get 1 trillion, there was no relevance to the human efforts or anything, because they could scale up very fast. And that's where many of the people who were smart realized that you need to catch the company when it is young, put in the money, let it grow fully, and then come to the market. So that is where there was basically a framework which has come in, which says the companies come to the market fully priced. Upside for the normal people is not there. After they become normal companies, they become linear payoff normally. Of course, some of them also give you non-linear payoff. In India also, if you have seen in early 90s, there was a new tech company. It was not called tech company those days, but it was a new technology of polyester, yarn and stuff like that, called Reliance, right? It has, of course, gone into newer businesses recently, but it was a new technology company which took off the Indian cloth market. And you can see how people have benefited. Similarly, later on, Infosys came. It was a very small, tiny company. Nobody even subscribed to that company's shares. It devolved. And then it ended up giving so much returns that people are still remembering those days of 92, 93 of Infosys. If they had bought 10 rupee share, it would be worth probably 50,000 rupees or something. In Reliance also, if you had bought it in 10 rupees, it might have been worth now, after bonuses and rights and all, it might be worth whatever, 50,000, 1 lakh rupees. Kotak Bank. I mean, there are millions of such examples in India and abroad, which tell you that they don't want company to come to the market faster. Smarter people will also help the company to uh, go to the clients, get them connected. And so that's the kind of function the private markets are playing, private capital markets like angel investors, venture capitalists, and private equity firms. And they, of course, give you loans. They also make you very tied to their loans. The loan rates are very exorbitant many times. The conditionalities are unbelievably difficult for the borrower, but they give you equity also, and then they make you borrow debt from them, and you keep on sometimes working for them. You think they are kind of sucking the blood out of you, and many uh, industrialists complain privately about those private funding people also, because in public markets, it's everyone has similar rights. Whereas in private situations, those people who give you money also basically put in a lot of conditions which tie you up as promoters of the companies. And so there are pros and cons, but effectively the lure of getting faster valuation, better valuation is so much that people end up taking the money from those people. And there is nothing wrong, because ultimately you are in business to make money, right? So if somebody is giving you larger valuation vis-a-vis the public markets, when you are making losses, nobody is going to come and give you a great valuation in Indian public market. But if you go to private equity player, they might give you $1 billion or $1 trillion, right? Like what we have seen for the Flipkarts and Byju's and all sorts of things, right? Many of them are loss-making companies, but they continue to attract billions of dollars of valuations, and which will not be available in private markets. But when they become profitable, then they come. That is the time they end up basically becoming normal companies, normal linear payoff companies. That's how I see.
Thank you. Now we have some questions from the audience. Over to Priyanshu for questions from the audience.
Thank you, Professor. Sir, my first question is regarding the present COVID scenario. We are seeing that even when the economy is contracting, Sensex is still rising. And this is not only in India, we can also see this in USA also, US markets also. So can you please share your thoughts on this?
See, basically, all of us are used to having simple, stupid answers for complex problems. And all the media, all even so-called experts who come on TV and write in newspapers tend to get befuddled by such things, saying that why the Lull Street is separate from the real street. Now, as I told you in my sort of session earlier, what is capital markets? It's for the long-term assets. The assets value are defined based on the profits they will generate over next 30, 40, 50 years. Then you bring them down to the net present value of today, right? So if the price, if the profits are going to go down for next 30, 40, 50 years, then those values will come down drastically. So what happens is there is a theory called efficient market hypothesis. If you are studying portfolio management and all, you will come across this framework. What it says is that at any point in time, price of a stock reflects all the information about that company. And if you take an index, which is about economy, which represents economy, all the companies in the economy, then that index represents all the information about economy, right? At any point in time, all the available information for today, tomorrow, day after, and after 50 years, after 30 years, whatever is going to happen as per the current understanding of all the humans in the world. Now, when the COVID started coming into vogue around February, March, COVID was not calculated or taken into account or discounted in the stock market prices anywhere in the world. because it came in as what they call black swan event. Never heard of before, never thought about before, right? It was not a information which was discounted. As soon as COVID started affecting people in Italy, in Greece, in America, the markets fell 40%. No asset classes fell 40%. Nobody thought it's going to, but because it was a new information and all the experts were saying that it's going to be huge number of people having infections and dying. In fact, if you recall, there were many experts who came from America uh, because in America nobody listens to them. But in India, all the NDTVs and all started quoting them. They came on television saying by July, August, India will have probably 10 crore infections and 2, 3 crore dead. Markets fell, right? Because new information came, it was very worrisome. And if that kind of 20, 30% people die, then the economic value over the next 40, 50 years of those companies will also come down. And that's why the markets fell. Then slowly, as the disease progressed, it is a deadly disease. It's a very tough disease to control. But people realized that due to lockdowns and other methods, the number of infections have been controlled and number of fatalities are even more controlled than what was expected. And slowly that information was no longer new because it got discounted upfront by falling 40%. And slowly, when more and more information came, less and less people got infected compared to what expectations was, less people died. Then people said this is a bad disease, deadly disease, requires tremendous amount of controls. Societies have gone instantly bad, but long term, it will not have much impact. And that's why slowly the prices started coming up. There is another reason also that still the economy has gone bad. It may continue to remain bad. But what happened is last almost 50 years, 49 years, the world has created an economic system which works on what we call fiat money. Fiat money is not Premier Padmini car, not that money, but fiat of the government. There is nothing behind that. Governments print money and they give it to you in some ways. And that fiat money has ensured that governments are able to print money at will. Before that, in Great Depression of 1929, governments could not print money because gold was not available. It was gold-backed currencies everywhere. But in 2001, when the World Trade Center problem happened, or e-commerce collapsed, all the e-commerce companies collapsed. Then in 2008-9, when the global financial crisis, all these times, the governments have solved these problems by putting more money. In financial crisis, global financial crisis, almost $8-10 trillion were put in by Europe, America, Japan, China, India, everyone put together. In the new COVID crisis, in first 3 months alone, the world powers, Europe, America, Japan, China, India put together, had pumped in more than $12 trillion in their economy. So what happened is suddenly liquidity came in, and the basic microeconomics and also macroeconomics, that more money chasing goods, what happens? Prices go up, right? Because goods remain the same quantity, more money is chasing, the prices go up. Similarly, all this liquidity which has been put into the world markets is now chasing those stocks. And that's why also it has gone up. But earlier problems were man-made. If you see the savings and loan crisis of America, before that, the Latin American bond crisis or debt crisis in 1970s, 1980s, then the World Trade Center crisis, then the global financial crisis, all were man-made. This is not a man-made crisis. We are trying to solve a medical crisis putting a lot of money. It is early days, 6-7 months only have passed, but many people, many policymakers, many politicians, seasoned politicians thought this will get over in 2 months, 3 months maximum. Now it is 7-8 months and still there is no end to sight. It may still have some pain left. But overall, why the real street and Dalal Street differ on many occasions is because Dalal Street is a slave of liquidity. Okay. And it also calculates all the future profits, not of today. So today's real street may not match with Dalal Street, but in long term, they converge.
Thank you for the answer, sir. The next question is from Vivek Shame, where he asks that how do you think the emergence of discount brokers and zero brokerage model would affect this industry?
Again, what happens is when commoditization happens, then basically every economic agent or a producer of goods and services try to sell it pretty much at marginal cost, not even at production cost, right? So you have again learned the economics, the marginal cost concept. So for the broker, which is the largest broker, what are his costs? Servers and manpower and all. But for an extra one trade or 5 trade from a one person, it's not going to cost him anything, right? Because his marginal cost is zero. So he's going to charge zero to the next guy, next customer who comes to him. Whereas other people who are not his size may not be able to compete because their marginal cost may not be zero. And that's how in every sort of every industry, when the commoditization of services, commoditization of goods happen, then such issues happen. And this is basically why commoditization happened, is because of the automation. Today, whether you are trading on behalf of, I mean, one broker is trading, which is a big name or a small name, both are coming to the exchange, both are giving you the same response time, both are giving the same stock. It's not that you buy a Reliance share from one broker will give you more dividend vis-a-vis buying Reliance share from another broker will give you less dividend, or one exchange versus another. Everything is the same, right? So it's a commoditized service. And so there, people who are able to give you the lowest cost, that's where the customers are going to go. And once that guy achieves that economies of scale, then he's not going to be even in losses. And similar activities are happening in e-commerce by giving discounts in e-payments like Google and this Paytm and all are giving so much discounts. I mean, they're giving cash back for buying 100 rupees through them. They're giving you 1,000 rupees cash back and all, right? A lot of such things. So they are trying to capture that market share where it becomes economies of scale is such that they don't make losses for that number of transactions, and each time they get little extra, that becomes their profit. So that's what is happening in stockbroking. And of course, they create also other models. They keep your money for margins, which may give them some interest, and all sorts of things, like they may actually lend some money to you for trading through their other subsidiaries for which they make money and all. Every other broker may not be able to do that. And that doesn't mean that the guy who's giving you discount brokerage is currently in profit. He might have somebody funding him to give this broking at discount, and then later on, when he achieves that scale, he becomes profitable. So, but this is reality of life, and there is nothing you can do about it.
Thank you for the answer, sir. Since you have mentioned about technology in BSE, so the next question is on the similar lines. The next question is from Ayush Joshi, wherein is asked that do you think that an exchange for cryptocurrency would enjoy a national presence like BSE and NSE does if the restrictions are lifted in the near future?
See, what is cryptocurrency, right? Have you played Monopoly in your childhood? Monopoly, there's a board and there is a money there. Each Monopoly board has a stack of money, right? And imagine your neighborhood, another boy or girl has another Monopoly board. And then in neighborhood, probably 10,000 Monopoly boards are there. And you start using that fake money for buying things. And actually the shopkeeper is foolish enough to allow you to do that. Eventually, you know that you can buy those fake money of $1 billion in 1 rupee by printing in your printer, right? And so you can keep on, and that guy will go to basically bankruptcy because his money will not be used. The shopkeeper, when he goes with your money to buy the real goods, nobody will buy, right? So making money, cryptocurrency is basically not by the fiat of the national government, right? I told you about fiat-based currencies. That in modern currencies are basically representation of states, power of the state. And modern nation states are conceptual entities. They are not physical entities, right? There is no physical any country, right? Whether it is Sweden or Italy or India. We think this is our country, that's why it is our country, right? And they are represented by courts, money, exchanges, companies. They are all conceptual entities. If you have not read the book by Yuval Harari, please read up, Sapiens. To give you an idea of most of the modern world is about our mental conceptual entities, not physical. Physical walls are easy to create and easy to break and stuff. But the societies don't run on walls or buildings. They run on conceptual entities, and money is a very important conceptual part of our entire society's existence. At the same time, all of us want money. So if all of us could make our own money, and we call them cryptocurrencies because they are sexy to say or they are glamorous to say, and you can make infinite number of cryptocurrencies and I can make infinite number of another cryptocurrencies. Bitcoin is basically an algorithm which creates, which comes out with few numbers. But you can create Bitcoin and then next to that, you yourself can create Nitcoin. Same algorithm, but your number starts, same numbers, but it starts with A. So everything A, then B, C, D, and so on and so forth. So literally everyone can have their infinite personal currencies. But that depends on other people's ability to accept your currency, right? Today, some fools are able to exchange that monopoly currencies in real money, assuming that further fool, next fool will buy even at a higher price. And that game is going on, but effectively it's a sabotaging of nation state. No nation state in the long term will basically tolerate that. As far as that game is small, it's okay. But as far as it becomes large, it'll become problematic for those nation states and they will go against them and ensure that officially they are not allowed. Unofficially, you can do whatever. You have many ways to lose money. One of them is cryptocurrency. Just to give you perspective, yesterday only I was reading about China's own national cryptocurrency is going to come. There was a rumor that has been created last few years that China is coming out with their own cryptocurrency. And it's going to be basically not cryptocurrency. It is the basically centralized database currency. So there are many situations like that, but cryptocurrency is the most bogus concept, which for some time it may last. And if you want to run on that, it's basically what I call smugglers' money. If you have seen old Hindi movies, they used to have that 10 rupee note cut off, and then the smuggler comes in ship, and he has that half note, and you have half note, they match both the sides the number, and then you give them the money, and they gives you the goods. That's a smuggler money, drug dealer's money. That is what it is. But I have my doubts about its long-term durability or existence going forward.
Thank you, sir. We have this question from Karthik, wherein it asked that how the direct market access facility to retail investor will impact the brokers. How can they remain relevant?
See, direct market access even is available today. If you are on your mobile, tomorrow you wake up at 9:30 to place an order. It goes from your mobile to the internet and then to the servers of the broker, and then straight away it goes into the exchange servers. There is no human watching it, right? So it's already direct market access. So people give more interesting names, and once that name creates that illusion in our mind, that's going to be something great. It is actually happening for the last 25, 30 years using internet and mobile-based trading and stuff like that. So it's there. The other, what they're trying to add is saying that you don't require broker going forward to trade on your ideas. But today also broker is actually charging you nothing, right? As you rightly said, discount brokers are charging you nothing. So what else additional functionalities are you going to get? In addition, he's going to give you some loans and other things, which you may not get if you try to do on your own, right? So some large guys may be able to do it. the small guys, I don't think they will find anything worthwhile in DMA. I mean, the DMA which they are saying that will be DMA, but current DMA is pretty much prevalent. There is nothing great about it.
I know, sir, we have crossed the limit. Can we take one more question?
Yes, please. Yes.
Sir, so this is the common question which I have got from many of the students. So they are asking that what one message would you like to suggest to the students, especially the ones who have interest in finance and markets in the present conditions?
See, till the time societies are there, humankind is there, finance will be required, right? So you won't be out of job. But in life, you will have many opportunities or many occasions where you will have to make decisions, uh, and those decisions will be what I call morally disturbing. Many times, especially if you are in finance, if you are in manufacturing, usually you don't have those issues. But if you are in finance, because money is what everyone wants, money is what everyone is after, and money is what you have as inventory, and money is what you handle in some or other form. There will be many opportunities and many occasions where will come where it will be morally wrong to do that thing, but financially lucrative for you to do that. Please be on the side of the morally right. Whenever you have to take a decision, do it because it is morally right, even if it is hurting you financially. Because that is what the society is all about. Your basic job as people in finance is to maintain the trust of the public. Each time you do something for your benefit against the interest of the public, that trust gets broken slightly, right? And when it gets broken by so many millions of finance people, then slowly people lose trust into the financial system. That's what is happening. So my request to everyone who aspire to be in finance or who is in finance is, whenever there is a chance, be on the side of good, even at personal loss. Right? I hope this is something you are able to understand. Probably if you don't, when you go to start jobs, some of you would have probably done the jobs, would be able to understand this. But this is absolutely important that money is important in life. Without that, not much happens. But the trust is the only thing that happens in finance. And when you lose that trust in your own eyes, let alone in other people's eyes, pretty much you are doing a disservice to the society and yourself.
Thank you, Ashish, sir, for such an insightful session. We are privileged that you took some time out of your busy schedule and shared your thoughts and experiences with us. I would also like to thank Professor Soni Thomas for moderating this event. Thank you, sir.
Thank you.
Thank you. This was an interesting session.
Thank you, sir. Thank you, sir.